Well, good afternoon and welcome to our HiRock clients and any other listeners who have joined us this week, and thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy, in financial markets, and in the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HiRock, and our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HiRock tab. Okay, as we do each week, let's quickly recap our themes for 2016 before we get started on what has happened over the last week. Our overriding theme for 2016 is that financial markets will remain volatile. January saw a pretty significant spike in volatility, but markets settled a bit in late February and in March. Up till now, thanks to continued monetary stimulus by central banks. Now, the big question remains whether or not the U.S. economy will continue to be able to grow while less positive global economic forces provide a drag. The consumer is not, at the moment, providing a significant lift to the U.S. domestic economy despite improving employment growth, and expectations for first quarter of 2016 are now showing almost no growth at all. More on that a little later in the call. Commodity prices, and especially oil, are trending higher now after a prolonged decline. Core inflation in North America has picked up a bit, but not so much in other parts of the global economy, leaving inflation-guided central banks in a bit of a quandary as to what should be their next steps. The European Central Bank and the Bank of Japan have pushed rates into negative territory to try and get the value of their respective currencies lower and attempt to drive their economies into growth through exports. Now, this has backfired somewhat as the U.S. Federal Reserve has pulled back on their desire to push rates higher, at least for the moment. It has become somewhat apparent that the limits of monetary policy may have been reached. Well, geopolitical wildcards like the UK leaving the European Union, Saudi Arabia, Iran, OPEC, and all the other oil-producing nations, the U.S. presidential election process, China, North Korea, terrorist activity, and the refugee crisis are all increasing the levels of uncertainty. We continue to watch bond markets for clues, but with some central banks forcing negative interest rates, that picture may be being distorted somewhat. However, what we do see leaves us concerned for global growth prospects. As we move into the release of first quarter earnings results, also known as earnings season, over the next month and a half or so, expectations are for a fourth consecutive quarter of negative growth. The last time earnings growth had 4 consecutive quarters of negative growth was in 2008-2009 financial crisis time. Investor sentiment is low, yet stock markets have moved to within small percentages of their all-time highs, making them even more expensive. As the great economist John Maynard Keynes once said, markets can remain illogical far longer than you and I can remain solvent. So it appears for those hedge funds who position themselves to be short of the equity markets and are being forced to cover back their short sales. We remain in a time of lower than average returns, where after 6 years of above average returns and as the cycle evolves, the longer term returns are moving back toward their averages. The total return, including dividends on our benchmark All Country World Index, is about a negative 4.75% over the last year. The total return on the other benchmark we use, the Canadian Bond Index, is a positive 0.5% through that same period. Meanwhile, our client portfolios continue to perform better than any combination of those two benchmarks. Okay, so let's have a look at what's been driving markets over the last week. It was a wild ride in January and part of February. However, volatility has eased up through March and April as the People's Bank of China, the Bank of Japan, and the European Central Bank have added further monetary stimulus, and the U.S. Federal Reserve has lowered expectations for higher interest rates. Volatility does remain below its long-term averages. CNN Money's Fear and Greed Index hit a low near 9 back in January. Now it has moved back into the extreme greed territory as more stimulative central banks have forced money out of low and negative yielding safe assets into riskier assets. Markets moved rather quickly from oversold to overbought in March. We suspect that the next move will likely take us lower. Well, since our last webinar, our benchmark world equity index is stronger by just a little under 3%. It is now up about a little over 3.5% on the year. Over the last week, Germany's DAX index was the best performer, and China's Shanghai Composite Index was the worst performer. Every week we've talked about our strategy for 2016 was to be overweight the Canadian equity market and underweight the U.S. equity market for rebalancing purposes. That trade got to be so favorable that we have now taken the profit and rebalanced back to even weight. Now on a total return basis, which includes dividends and currency fluctuations, with the TSX up by about 6% and the S&P 500 in Canadian dollar terms down by about 5 3/4, we had a net difference of about positive 11 3/4 in our favor. The trade did work very nicely. That is how active rebalancing can add significant value. The TSX has been the best performing country index in the developed world this year, and the Canadian REIT index has also done extremely well. We also have an allocation to the REIT asset class in our global equity model. After hitting highs last year near 63, our benchmark world equity index made new lows near 49 in mid-January and then again in early February, which was about a 22% drop from the highs before finding buying support from short covering and a little value investing after such a great decline. Now, at the moment, the top of the down channel has been broken to the upside as buying has driven prices higher, and the next test of selling resistance should be near the 58 to 59 level. The new uptrend channel shows support at the 57 level now. Trading volume continues to remain low. Without this volume follow-through, it will be difficult for the market to sustain any upward momentum. As we entered earnings season, expectations were quite low, as was investor sentiment, and short positions were being established. Now, the jump in oil prices and slightly better than expected earnings has initiated some relief buying and short covering. The trend may be changing, but we need to see confirmation of that and in all of our value metrics before we are going to be inspired buyers. U.S. high-yield bonds were higher this week as investors added risk to their portfolios. Canadian preferred shares slipped in value. U.S.-Canada 10-year yield spreads narrowed to just a little under 0.5% this week from 48 basis points last week, so from 48 to 46 over the course of the week. It's continued concerns about the first quarter economic growth in the United States that is driving this situation. And oil prices slipped a bit this week after OPEC and Russia failed to come up with a production deal, as Saudi Arabia and Iran are not prepared to cooperate with each other politically. Oil found buying support at the lower end of its new uptrend channel yesterday after the OPEC talks broke down, but has recovered to move back above $40. The next tests could take us to upwards to $45 or downwards to 38 as it trades in that trend and within that range. Shrinking supply expectations are the main driver at the moment for higher oil prices. Well, the Bloomberg Commodity Index continues its uptrend as well. Now, our benchmark World Equity Index is comprised of about 53% of U.S. companies, so we keep a close eye on what is happening in the U.S. economy. The U.S. Federal Reserve, as we all are aware now, modified their expectations for higher interest rates in March as economic conditions continue to remain under pressure. More of that data we saw last Wednesday. U.S. March retail sales showed that the consumer has not been spending as much as had been anticipated. The consumer is 2/3 of the U.S. economy. Last Friday, March industrial production in the U.S. was reported to have fallen a more than expected 0.6%. Industrial production has been declining since the end of 2014. So expectations for first quarter GDP are now within a rounding error of 0% growth, as housing starts data and consumer spending data were added in since our most recent update. Well, at the moment, it appears that the U.S. economy is not providing the support for the global economy that many had hoped for. So let's have a look at what's happening in the global economy after all the monetary stimulus from the European Central Bank, the Bank of Japan, and the People's Bank of China. We are still waiting to see the results. In the meantime, the International Monetary Fund, as we mentioned last week, once again lowered its global economic forecast. The world economy will grow at a rate of 3.2% this year, down from a projected 3.4% in January. The Broad and Diversified Benchmark Equity Index, upon which we gauge the performance of our model and our portfolio performance, covers close to 2,500 constituent companies domiciled in about 23 developed countries and 23 developing countries. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. The U.S. has more than half of the companies. Europe has about 16%, Japan about 7.5%, the UK has about 6.5%, Canada is about 3%, and China about 2.5%, just to give you a general guide. Well, the Euro area March Consumer Price Index data was released last week and remains well below the target 2%. The European Central Bank meets on Thursday of this week to announce its latest interest rate decision. The Bank of England held policy unchanged at their meeting last week, but indicated that there were growing risks as a result of the referendum on whether to remain in the European Union, which will be held on June 23rd. We've covered this a fair bit in previous webinars. We keep an eye on that as we go forward. China's first quarter of 2016 GDP data shows a less robust economy with an annualized growth rate of 6.7%, which was in line with expectations. However, the quarterly data of only 1.1% growth did not line up with the annual data, which leaves us a little uncertain and more than a little confused. So we have to keep our eye on what's going on in China going forward a little bit more closely. Well, here at home in Canada, last week's interest rate decision, the Bank of Canada reiterated that the oil price shock continued to weigh on the Canadian economy. The first quarter GDP growth appears to have been unexpectedly strong, but some of that strength is apparently due to temporary factors and is likely to reverse in the second quarter. Slower foreign demand growth and the higher Canadian dollar. Business investment is still shrinking due to sizable declines in the energy sector. The combined effect of all these global and domestic developments would have been a modest downgrade of the bank's outlook. However, the fiscal measures announced in the March federal budget will have a notable positive impact on GDP. The bank now projects real GDP growth of about 1.7% in 2016, 2.3% in 2017, and 2% growth in 2018. I'm just going to ask whoever joined the call most recently if they could just mute themselves because we're getting some feedback from their microphone. Thanks so much. To add to the Bank of Canada's concerns, the Canadian dollar has disengaged itself from the movement of oil prices, which are, and the Canadian dollar has been closing in on 80 cents US as interest rate spreads narrow between Canada and the US on the back of a slower US economy and less likelihood of US interest rate concerns increases. So what do we see on the horizon? Well, let's see what bond markets are suggesting. So each week we look at these yield curves to assess what the bond market might be telling us. A positive sloping yield curve, such as we see in the US, the UK, and Canada, should give us some hope of better economic conditions in time as investors want to receive greater returns to protect themselves against future inflation. Negative yields below the red zero line indicate fear of deflation in the short term, where investors want the safety of government bonds for protection. And the Japanese curve is negative almost out to 15 years. And in essence, you would be paying to own the safety of Japanese government bonds as opposed to them paying you to borrow your money. And that yield curve has also flattened further. It's not a good sign for the Japanese economy at this particular time. The US, UK, and Canadian yield curves have also flattened marginally over the course of this week. Well, historically, high-yield bond markets have led equity markets, but lately, high yield has been chasing equity markets higher. Now, the world is upside down at the moment, which leaves us confused and uncertain and not likely to be adding risk to our client portfolios. The Canadian high yield continues to lag US high yield. In fact, Canada usually lags on the way up and down, which lowers overall volatility in the Canadian high yield market. There is still an increased risk of defaults in the energy sector that could impact the financial system in the longer run. We are watching developments here quite closely. Higher oil prices have been reducing the concern in financial markets, but we think that is premature. There is a spotlight on massive energy loans that most investors didn't know about until quite recently. These unfunded loans have been promised to energy companies that haven't yet tapped the money. Many banks historically haven't disclosed these loans, but have begun to recently, following the extended slide in oil and gas prices. In the first quarter, a handful of energy borrowers announced more than $3 billion of drawdowns against these types of loans. Those commitments are expected to trickle down to bank earnings and saddle firms with more energy exposure at a time when they are trying to pare it back. Well, as for equity markets, some investors are still buying stocks, driving prices higher as they seem to be comfortable adding riskier assets to their holdings. We are not, and here is why. When investors buy stocks, they buy a stream of future earnings. Now, the price-to-earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.2 times. Now, the 12-month forward price-to-earnings ratio is currently at an expensive 16.8. Last week, it was at 16.7. At the equity market highs back in May 2015, it was at 17.1. So, given the economic circumstances and the uncertainty at the moment, it is really quite hard to justify buying expensive stocks at current levels. Well, it is earnings season, as I mentioned, and as a result of downward revisions to earnings estimates, the estimated year-over-year earnings decline for the first quarter of 2016 is now a negative 9.3%, which is below the expected earnings growth rate of 0.3% as of December 31st, 2015. It would be the fourth consecutive quarter of negative earnings growth. Now, on average, approximately for all of 2016, analysts are projecting earnings increases of 2%. But at the beginning of the year, analysts had projected 2016 earnings growth of 7.4%. However, stocks are still expensive. Well, last week we talked about how many companies purposely lower estimates so that when they announce results, they can look like they beat the lowered estimates. Now, on average, over the last 5 years, 67% of companies have beat estimates each quarter. But this far, with approximately 10% of the companies having reported 71% have beat estimates. But keep in mind, it's only 10% of companies reporting so far. The S&P 500 and our global benchmark All Country World Index appear to be finding something positive in this. For us, this is just matching expectations and way too early to get a good read on the ultimate outcome. The recent rally in stocks has pushed the enterprise value to earnings ratio higher, back above 13 times and well above the longer-term average. Corporate profitability, the white line in this chart, tends to lead the S&P 500 with a lagged effect. We see no reason for it being different this time. In fact, it looks like an elastic band that has been stretched too far. Historically, corporate profits have turned lower preceding a recession. Corporate earnings growth has been declining in the previous 3 quarters and is now expected to fall in the first 2 quarters of 2016. This leaves us more than a little concerned about the state of the U.S. economy. There is still a huge gap between investor sentiment, the white line, and equity prices, the yellow line, at the moment. But when investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell. So margin debt data tends to provide an indication of equity market direction. The debt market turned lower last May and lower again in January of this year. The most recent data show that trend is continuing and keeps us very cautious. When the spread between large cap markets like the S&P 500 widen over small cap markets like the Russell 2000, it is historically a sign of markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. When markets fell, that gap narrowed considerably, but the gap has widened as large cap markets have rallied more while the broader Russell 2000 has lagged. This also adds caution. So while the S&P 500 is broken up through the top of the downtrend channel, we are not convinced, especially because volume of trade has not followed the move higher. So what does it all mean? Well, since last May, we've taken a cautious and defensive posture to investing. And in light of our key theme for 2016, we remain defensive because we are not convinced that with all the economic data currently on our radar screens and all of the metrics that we monitor to determine if there are buying opportunities, which we present to you here each week, that there is any good value in today's equity markets. Until we see otherwise, we shall continue to be patient and let others chase what we believe to be expensive asset prices. Cash and cash equivalents have been and continue to be important defensive assets for us, so we are carrying greater than normal cash balances in our models. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, your goals, risk tolerance, and time horizons. However, the ongoing research and analysis that we do at HighRock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe add value to the long-term performance. That is how we justify our fee. Our HighRock models are built to incorporate the need for diversity and balance with fixed income, global equity, and tactical mid and small cap companies. And because our key theme for 2016 is focused on greater levels of volatility, the cash or cash equivalent component in client accounts, the underweight exposure to equity markets, and the exposure to safe government bond markets helps to mitigate the impact of volatility on our portfolios. Our tactical model has taken advantage of some value purchases so far this year, like buying Rona before it was taken over by Lowe's at a 100% price increase, and picking up cheap shares in Paramount Energy before it tripled in price, and we sold it. All of this with a significant cash weighting on hand. This is how we can add value to our clients' portfolios and get growth at the best risk-adjusted returns that we see possible, and meanwhile, stay ahead of the returns of our benchmark indices. Okay, what's up for next week? Well, we're going to see data tomorrow from the UK on the current status of employment. On Thursday, we're going to get UK March retail sales. Then also on Thursday, we have the Euro area interest rate decision. We will see on Friday Euro area consumer confidence and manufacturing index. We'll see the April manufacturing index in Japan, and then some data from Canada, February retail sales, and March inflation. Over on to next week, nothing until Tuesday. Then we'll get some U.S. data, March durable goods orders, April consumer confidence, and don't forget to be here to tune in to our weekly HIROC webinar. On an administrative note, as you may all know, but I shall repeat as a reminder, our communication process is wide open. We send out quarterly reports, insist on at least semi-annual reviews, have these weekly webinars, and write blogs which are available on our website. However, we also encourage you to contact us if there is anything you wish to chat about, be it strategy or a change in your circumstances. There are very few, if any, portfolio managers who offer this level of service, so please take advantage of it. All right, well, that's it for today's discussion. If anyone who is listening might have a question, this is the time to take advantage of us being here, and feel free to ask. All right, if you do have questions and wish to email us, we would be more than happy for you to send them. We would also love to get feedback on these webinars, what you think is good, what is not, or what else you might like to see us cover on these calls. As always, thank you for taking the time to tune in. Have an excellent rest of the week and a great weekend. Don't forget to tune in next Tuesday. And until then, this is Scott Thomason signing off.